Coming up towards 13 minutes after 7 o'clock in Trinidad and Tobago. Let's shift our focus to the economy and the state of the economy, and with specific reference to interest rates, because you know it's interest that drives the business world. It's the ability to let your money grow, as the men refer to. It used to be called usury in the good old days of the Old Testament. It was frowned upon. Now it's celebrated. Well, given some improvements in the energy and non-energy sector, as stated by the government, how does that impact on interest rates and so on? Well, we have someone who's very well qualified to talk about this particular situation in relation to the economy of Trinidad and Tobago. Subhas Ramkhelawan, former independent senator and managing director of Bourse Securities, is here with us, and he's been conducting a webinar series. It's available on YouTube as well, offering his perspectives on interest rates. Sir Ramkhelawan, good to see you once again. Thanks very much for joining us. So what should be happening, re-interest rates?
Well, I think, first of all, interest rates is the price of money. And when the price of money is too high, it can have an impact on the economy. And when it is too low, it can have a stimulative impact on the economy. The central bank, in its last monetary policy info, kept the interest rates, which is the policy rate that impacts all interest rates, called the repo rate, at a level of 4.75%. The arguments that have been raised for keeping it at that high level are arguments that we would want to consider, interrogate, and make our own perspectives on what has happened. So let's talk about that. If the price of money is too high, then what is happening? It might dampen economic activity. And my argument is that the price of money, interest rates right now, are too high. And they're too high on the basis, you have to go back into the history. Not long history, just short history, back to about the end of 2014 into 2015. And at that time, over a period of about 15 months, this indicative interest rate, the repo rate as it's called, moved from 2.75% to 4.75%. And the argument that was made then was that the economy was somewhat overheated, one. Two, that there was a need to maintain an interest differential between what US rates were and TT rates were to avoid capital flows outside of the system. And the domestic economy was somewhat overheated, and therefore it needs to be dampened. Step forward to today, in March 2018, April 2018. What has happened? Well, our domestic economy is on the down low, if you want to put it that way. And there is need for some sort of stimulation. Now, there are two ways you can stimulate the economy. One is on the fiscal side. If the government has resources to put into the system, it can drive the economy by spending more and giving that fiscal injection. Of course, that is not the case now. In fact, the coffers are bare. And we need to look at the other policy construct, which is the monetary side. One is the fiscal side, and this is the monetary side. And the monetary side is clearly the responsibility in the main of the central bank. So if the domestic economy is dampened and we have the capacity to adjust interest rates, then I am arguing that we should so do. What do I mean by us having the capacity to improve, to adjust the interest rate downwards? Well, there is a sufficient pool of liquidity in the system to drop interest rates and to allow for funding to go to those who need it, whether in the consumer side or whether on the investment side, the business side, at a lower price. And this, the argument is, should give some fillip to the economy, the lower price of money, and that gives you.
So 4.75%, what would you recommend should be the
I believe we should go back to the 3%. Cut back
immediately, or should it be a gradual
in stages? When the repo rate was run up from 2.75 to 4.75, it was a period of 8 consecutive quarterly increases. And therefore, you have to test to see what is the right balance. It's like sitting in your bathroom and making sure you balance that water. So if it gets too hot, you go back and adjust. If it goes the other way, you go back and adjust. So that's one of the, we need to drive the economy through a monetary initiative. And the central bank has been sitting at this 4.75% without a cogent and cohesive argument for being there. Now, I say cogent and cohesive because the argument that is being raised is that we need to maintain the interest rate differential between the TT rate and the US rate.
Explain what that means.
Well, okay. So you want to have an interest rate that is higher than the US interest rate because the argument is that you will stem the flow, the capital outflow.
You don't want capital flight.
Okay, because people would, if they were too close, they would move to US dollars. That argument is fallacious in today's world, and I'll tell you why. When we had an interest rate differential that was effective, it was because person who wanted currency could actually go and get currency when they wanted, so they had access. And the second point is, today there is a vast chasm between the official rate, the rate that the central bank purports to sell money to all and sundry, or put money into the system, and the unofficial rate. In fact, I am not speaking out of turn. We can go to what the IMF has said, that the currency is overvalued by 25 to 30%, which takes you into $8, $8.50 region.
And that is a discussion that many people have brought forward. They say that, the real value of the TT dollar is at least 7.8 or almost 8 to 1.
So why would somebody hold or go for an interest rate differential, whatever that is, when they know that the currency is the bigger story and it is, you become indifferent. It is not an issue. That's what I mean. So that the argument is use the interest rate. The other argument is that about inflation. The price of money, you don't want to overheat the economy. But right now, inflation in 2015, at the end of 2015 and thereabouts, food inflation was 18%. Headline inflation was 9%, and core inflation was about 1.4%. Fast track to today, food inflation is 2.6% from 18%. Headline inflation is 0.9% from 9%. And core inflation is down to 0.5% from 1.4%. So there can be no argument that there is inflation, and therefore we need to contain inflation by keeping the price of money high. There's no argument for that.
And Mr. Ramkhelawan, a lot of these discussions, many people sometimes they say, I was listening to Mr. Ramkhelawan and so on, but that had nothing to do with me. There's for all these big fancy money managers who just want to shift around their millions all over the place and so on. But if you could take it to the level of the ordinary citizen who might be saying, with the greatest respect, Mr. Ramkhelawan, what is that to do with me?
Okay. The price of any commodity is important to you if you use it. So if the price of tomatoes, you might say tomatoes, if the price of tomatoes is high, you mightn't buy. You might wait till it gets to a lower price and then you start to consume. In the same way, for the borrower, if the interest rate is too high, and for example, on the investment side, if the rate of interest is so high that I can't make $1 out of it, then I will stay away from investing. And therefore, the price of money is important to you. You will have to borrow at a higher rate if the wrong policies are in place. And I'm arguing that there is need to relook where we are with interest rates, the policy construct, and the message that is being sent out. Because here's what happens. The higher the policy rate goes, the higher the prime rate goes, the lending rate of the banks. It is a message that goes out to the banks. But interest rates have gone up, lending rates have gone up, but funding rates, your deposit in the bank, while interest rates have gone up from 7 to 9% at the prime level, funding rates have remained, your deposit rate has remained at 0.2%. So who benefits? There is a greater spread to the banks in their cost of funding and their cost of lending. But you, the person who needs to utilize the funds, may not be able to access it because of the higher price that is it at now.
Are there any negative consequences for doing what you are recommending, a gradual reduction of this interest rate?
I can't see any strong arguments, and if there are arguments, the pros outweigh the cons. By that I mean, you would recall in the crisis of 2007, 2008, which continued for 10 years internationally.
Yes.
There was a liquidity problem. There was not sufficient money in the system. That is not our case. Our case is
we have
too much
excess
money.
liquidity. That's what I've heard. I mean, I am not an economist certainly, but you always hear this comment about excess liquidity.
We have $3 billion TT dollars slopping around for our home. The banks cannot lend because nobody is borrowing. Slopping around for
So why
our
they
home.
don't reduce the rates?
Well, the point is that the policymaker needs to send that message, and the policymaker is the central bank. And when the policymaker adjusts the repo rates, normally you would find that the prime lending rate falls, so that when the repo rate was 2.75, prime was about 7. The repo rate goes up to 4.75, prime is 9 to 9.5%. Need to relook? We need to relook because we are looking for mechanisms that would help to stimulate the economy. If it is not on the fiscal side, we have to look to the monetary side.
Sure.
And all the conditions are ripe for an interest rate adjustment downwards. Let me hear the argument. The argument of interest rate differential is moot. It is fallacious, 1. 2, the argument of liquidity, that we don't have liquidity, etc. There is so much liquidity. In fact, when you compare us to all Caribbean countries, our liquidity of 2 to 3 billion is one thing. But the second thing is the primary reserve rate is the highest in all of the Caribbean, meaning that for every dollar a bank takes in, it has to put aside now in Trinidad and Tobago 17 cents.
Yeah.
But there are hidden reserves, so that bankers are saying, well, when we take in $1, the central bank, through various means, takes out 25 to 27 cents. So I only have 73 cents or 75 cents to lend for every dollar raised. Yet still, I only have 75 cents to lend, but there's still money slopping all over the place. There's no poor liquidity, and that is the point that I'm making.
And I again, just listening to people in business talk about these things over the many years, there's often the comment that our financial sector is still very, very conservative in many respects. Is that correct, or is our financial sector more, including the commercial banks, are they more dynamic now and more reactive than they would have been previously?
Well, I would say conservative is normally a good thing, because you don't want to get outside of a certain range and then put the economy in, the economy
risk,
and the
yeah.
banks
Yeah.
at risk, and savers at risk,
Yeah.
who deposit their money in the bank. That is a good thing. But to be too conservative is an area, it's just like when I talked about going into your bathroom.
And
You have to get the right balance.
balance.
It's either too hot or too cold. And I'm saying to you, we need to give stimulation and put the heat up a little bit, so that people can go in there and borrow and look to invest and look to spend, so that it gets the stimulation in the economy from that channel as is necessary today.
We're almost at the point of wrapping up, Mr. Ramkhelawan, but so if it sounds as sensible as you are advocating, and I'm sure there might be others who have a very different view in relation to it, why isn't it happening? Why hasn't the central bank stepped forward?
Well, I would argue that they are operating on a fallacious argument, which is the interest rate differential, 1. 2, it is clear that the domestic economy is in a state that needs some sort of stimulation. 3, that we have the liquidity. And those are the main things that you will look for in terms of carrying the argument forward. Why is the central bank at the stage that it is in? I think it is operating on certain premises that need to be relooked, and the clear conclusion will be, let's adjust interest rates as a monetary tool to help to stimulate the economy.
Subhas Ramkhelawan, thanks very much for taking the time to join us this morning, the Managing Director of Bourse Securities Limited. And I'm glad you made the reference to tomatoes as well, which reminds me I had to pick up 2 pounds of tomatoes this morning because your wife is supposed to be making tomatoes choker for it. I'll keep saying tomatoes choker and I always get buff up for it because it's tomato choker, not tomatoes choker. As I was reminded, it's not oranges juice, it's orange juice. So get with the program. So I'll try to sort that out as well and find out what the price of tomato is when I get to the market after the show this morning. We'll take a break and continue here on Morning Edition.